and estimates. My colleague Reema caught up with the management to discuss their Q1 performance, began by asking them about their annual revenue guidance. Listen in.
This guidance of 3 to 5% is something which we gave in the beginning of the year. And we did factor in the first quarter softness, which is quite similar to the previous years. And of course, Q2 is going to be a growth quarter, and Q3 is where we usually deliver peak performance. At this point, we feel confident of the overall guidance for the year.
But you're confident about achieving that guidance, but do you think you will get to the upper end of the guidance, or is it going to be lower to middle?
We are confident of meeting a 3 to 5% guidance. No further qualifications of higher end or lower end at this point. Just one quarter is over, so probably next quarter we may fine tune it a little bit.
Sure. One more question. You've also said that you're seeing some early signs of discretionary demand bottoming out, but it's too early to call it with certainty. What are these signs of green shoots in discretionary demand?
If you see the verticals like technology and services, we've delivered a good sequential and good year-on-year growth. And I did call out these verticals even a couple of quarters ago that the pipeline is improving, and we expect to see some good momentum on this. So that's definitely played out. But having said that, in the last 7 quarters or 8 quarters, there has been kind of differing kind of signals that we've been getting, and sometimes the ramp-ups are very short cycle and things like that. So that's why I've not called out any pickup in demand. The demand situation remains pretty much the same as what we had talked to you 3 months ago when we gave the annual guidance.
Prateek, can you explain the margin performance? It's declined by 50 basis points, and with impending wage hikes, how comfortable are you with the margin guidance, or is there a risk to it?
Good morning, Reema, and all the viewers. I think, it is pretty much along the expected trajectory. If you see even our last 2 years, the quarter-to-quarter trajectory has been, the first quarter is the weakest, around this 17% in both the previous years as well. And then it's the second quarter where we pick up to, let's say, somewhere around 18%. And then the third quarter is the peak, driven by the software seasonality, which is our most profitable segment, as you know. And then the fourth quarter is kind of near the annual average, again, just like Q2. So that's the trajectory, and we seem to be following that. Given the first quarter decline in revenues, I think 50 bips decline is pretty much par for the course. So no special comment on that.
But there is an impending wage hike which will further put pressure on your margins. So are you still comfortable with the margin guidance, or is there even a little bit of a risk as the year progresses?
So the wage hikes, last year itself was a delayed cycle, delayed by a quarter for everybody practically. So we'll have to see what we do this year. We haven't still made the decision, as we discussed on Friday as well. So we'll have to wait and see, and we'll do what it takes, pulling out efficiencies from the business and to do the right things for the employees as well.
Okay. CVK, your deal wins, the TCV, total contract value, is down 14% on a quarter-on-quarter basis. And you said a couple of deals got pushed and delayed to Q4, though deal bookings will be pretty strong going forward. What was the reason for the delay?
Yeah, I think our overall bookings came in quite in line with our last few quarter trends. We've been clocking about $2 billion of net new TCV for the last several quarters, with the exception being the Q2 of last financial year, where we had a big spike in the deal wins. This quarter, we expected it to be a little more, maybe 2.3, 2.4, and couple of deals got moved to the next quarter. It is really nothing to do with anything to do with the macro or anything like that. It is just that the logistics of getting an agreement signed got delayed, and we expect that to happen in this quarter.
And how is the pipeline compared to what it was 3 months ago?
Yeah. Pipeline remains pretty much at the same levels as what we had in the beginning of April. However, the pipeline also needs to be further qualified into the advanced stages in which deals are and things like that. So we feel a little more comfortable about improved bookings in the upcoming quarters. That's really what our takeaway from the pipeline analysis is.
Do you think this year, though, the deal wins in FY25 can be better than what we had in FY24?
I mean, you still have 3 quarters to go, and deal wins tend to be a little bit spiky in nature. So I don't want to take an overall call. But our overall expectation is we will have a better total TCV booking than what we had in the last year. At this point, it's just an expectation, but we have to see how it plays out.
So FY25 deal wins should be better than FY24. Prateek, you've also indicated the intent to hire fewer freshers this year. Can you tell us the reason why? Because hiring generally also has been subdued over the last few quarters.
Yeah, so I mean, we've called out a number of about 10,000. Last year, the fresher hiring was 12,000. So it's kind of in the same ballpark range, if you like. It's still early days, and let's say if things do become better, we could probably go over 12,000 as well. So we moderate it or monitor it across the quarters. Especially the off-campus is something that gives us flexibility to adjust those numbers in line with the growth and in line with the attrition as well.
And how is the attrition in the system? For you, the attrition picked up quarter on quarter?
I would say it is flattish. Yes, numerically, 12.8 versus 12.4 is higher, but I would say it's along that same 12 to 13 band that we have been, I think, for probably more than a year now.
CVK, coming to generative AI, because you've called out certain productivity benefits, I think 50% in BPO and testing, 10 to 30% in ADN, and up to 10% in operations. How is this going to play out? Will you have to pass on these benefits to your clients, or do you think it'll start reflecting in margins, or are you going to bid more competitively?
Yeah, I think there are multiple variables that play into the whole productivity paradigm. And I did also call out that some of these productivity goals that I talked about, it plays out over the next several years. It's going to be a journey where we start with putting together what we call as our HCLTech AI Force platform, which can be used to derive efficiency out of everything. IT operations, business operations within an enterprise. And it's a journey, and I mean, it will give you some year-on-year productivity, which is a little higher than what we had seen in the past. I think it's largely will get passed on. That's how I see it. There will be little areas where we may get some additional benefits, where we kind of agree on a risk-reward kind of arrangements. There could be some benefits that will accrue to us.
And just one final question about the near term, because you've called out Q2 is going to be a growth quarter. So tell us your expectations. Will it be better than what we had last year, even taking into account the impact of the JV divestment, and individual in sectors and geographies? What is it that you expect?
Yeah, overall, we expect Q2 to be a growth quarter. In terms of verticals, barring financial services, we are expecting growth in all verticals. We also expect to grow in all geographies. However, 2 things to call out: financial services would decline because of the divestment that we had announced. And for the software business as well, it is a little bit weaker in the JAS July, August, September quarter. So I'm not calling out any specific growth percentage or want to say it's better than last year and things like that. Overall, it will be a growth quarter.
Okay, well, that's the word coming in from HCLTech. Let's